Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, July 28th, 2020. We'll keep it quick. I want to just touch on a few things. We'll look at the broad market. We're still waiting on the big earnings reports from the for the five FAANG stocks on Thursday after the bell. So we really will get a much better idea, I think, where this market wants to go. In other words, the next trend. We should have a good idea by no later than early next week. And what I'm talking about here is, when you look at this S&P 500, turn off all the lines. Here we are today, where we closed. We're looking at the same level. If I put a horizontal line here, all the way back to this stick right here. That's June 5th. So we're talking 2 months of sideways trading. So in other words, the stock market hasn't gone down, but it hasn't gone up either. It's peaked at least for the last 2 months there, and so waiting to see which way it goes from here. So these are the trend lines I have. We have this trend line just broken with the 318.30 support that we hit. Clean negative divergences, the type of divergences I like to see on the daily chart, and I'm talking about nice separation between the peaks in the indicators, what you have there. So that's textbook divergence with the stock market making a slightly higher high, and again we're slightly higher above that previous high, but then we're back down below it now. So that gave us that new divergent high right there, confirmed divergence on the daily chart. And same thing. That was, as I pointed out, that was the last time we've had divergence since the big drop into the March lows. So again, waiting to see what the market does. QQQ is looking very precarious. It's the most precarious technical posture that we've seen since really back then, and even back before the drop into the March lows. We didn't even have divergence on the PPO. It made a new high, but we did have a clean bearish PPO crossover. Here we recently had a bearish PPO cross. We have confirmed divergence there, and negative divergence on the RSI as well, setting the stage. And of course, there's still on the weekly charts as well. We have the divergences on the Qs and SPY as well there. Let me just actually no. Not, we do have it. This was a divergent high back there. Remember, the S&P 500 and every other index, everything but the NASDAQ 100 is still well off their highs. I'm talking about the Dow, the S&P 500, small caps, mid caps, and again the Qs. I often talk about it. It is an index, a basket of 100 stocks, but it's not really representative of the U.S. economy. It's more representative of the tech sector. So that's that big trend line right here, and the lows of we had that bearish engulfing candle, and we never have received the follow through yet. Wanted to see red candles. The next day was green, but that's the day I'm looking at, that July 14th low that really I still think will put the nail in the coffin or start a much bigger drop if and when it gets taken out. Because if we take that out, we're also going to have taken out the trend line. So that's what you want to watch for. And again, the market's probably going to hold up until those big FAANGs report. But anything's possible, and that's why I do these videos. Sometimes you think it's going to hold up, because that's usually the case when you have a lot of market moving stocks or major economic reports. But sometimes it all depends on the supply and demand dynamics. If there are a lot more longs that want out at this point in time than longs that want in, then you're going to see profit taking, or you may see profit taking. So watch those levels. Doubtful you're going to get anything like a waterfall type or a big powerful sell-off before they report, but you could break down, and you could break down and go a little bit lower. All right, so like I've been saying, the odds for whipsaw signals are increased until we get those market-moving FAANGs out of the way. But the technicals are clearly set up that way. Despite how resilient the trend has been, I can say this is clearly, to me, a bearish technical posture. So in other words, it's a short setup, if you will, just needing the catalyst or the the entry, which would be a breakdown. Again, a solid break below the trend line, especially the daily close. But at this point, and even actually since that last well, it was back July 14th, I've been saying we need to take that low out with conviction to get things going. So that's how it looks. Tech's already broken down too, but it's just hanging in there. I have this purple uptrend line. Tech broke down, XLK, red candle, but hit that support level. And again, this is also largely due to the fact Apple, everyone's waiting to see what Apple reports, what Apple, Facebook, Alphabet, even though those guys aren't in here, believe it or not, they're considered big tech stocks, but they group Alphabet and Facebook in the communications sector, and Amazon they throw in the consumer discretionary sector. So you already had Microsoft report. We know what happened to there. They didn't like the market's reaction wasn't that hot. That's a lot of what this was right there due to Microsoft reporting. And then on Thursday after the bell, we have Apple, which makes up over 1/5 of this the tech sector here. And again, quick update on NQ. The other day we had near-term sell signals, and the 60-minute trend line, that trend line right there was broken. It was impulsive. We set up, had a little bear flagging action in between, and that played out well. There was a breakdown, so the flag played out, and we set up yesterday morning. As mentioned, we might have a larger bearish pennant here. Never broke down, but until today. If you extend the lower line, that's what was a catalyst for today's breakdown. So we rallied up, hit that, ran right back into that 1070, 773 resistance, reversed off there, broke that, and look where we closed. We're ping-ponging between these levels. I have not modified any of these lines, at least since the last few videos, last several days, at least this week, or maybe for the last couple weeks here. And that's the level we hit today on the reversal, 10,508 right there. So that's support, and it works this way. If they, tonight, tomorrow, next week, if that level goes, and that opens the door for another move down to here. Now we already hit this. This is a support zone. These two levels in close proximity, 10,337 down to 102.90. We already checked it recently. We hit the top of it here. We had some reactions here. So that potentially opens the door if we get there. Let's see. We've got a few days before the fangs are out of the way. So is it possible? I mean, yeah, we could certainly go down below there. All I can tell you is, the odds of whipsaws are a little higher now, but this is the way it works. If they take out the bottom of that zone, it opens the door to move down to the next level. If something happens and they can pop this level here, the 10,773-ish level, then that would open the door for possibly a back test of this trend line. So those are levels to watch. Trade it as you like, or sit aside and stand aside and see what happens on Thursday night and into Friday. ES, let's take a look at that real quick. That is not ES. This is ES right here. Let's put this one down here, and you can see the ES is the S&P 500 futures. We broke down. That sell signal is still intact, but again, we're not doing much since then. We had an impulsive breakdown, kissed that 3190 support / target, bounce from there, and kind of just meandering around. So same story. We're back to where we were, a while back. It's been a couple months, right back to that point. Sometimes you break down. See, we didn't have, 4 of the big 5 FAANG stocks reporting here. So this breakdown, when you had the breakdown, the selling was impulsive this time around, and that's what happens. Sometimes you break down, you never look back. Sometimes you break down, you back test, and you go down. And sometimes you break down, you kind of meander around for a while, and then the breakdown either plays out for a nice move down or not. So again, levels to watch for whatever it's worth. Let's look at a few other things. Yeah, I still think commodities are a nice place for part of either swing trading account or longer term trend trading account. Multiple opportunities here. This one's NIB, the Cocoa ETN. Watch, rinse, repeat. Keeps hitting this trend line, step in long. It was last mentioned long on that last pullback. So not only did you pull back to trend line support, you also had nice big divergent low. So again, these charts to me for long positions look infinitely better. The risk reward profile, that does not guarantee they're going to outperform the stock market. It doesn't even guarantee they're going to go up, but I can tell you that I feel much more comfortable having part of my long-term funds, stuff that I'm not actively managing, and even some swing trade positions that I'm actively managing as well, but having positions in these commodities. And from that last kiss of that trend line just a couple weeks ago, cocoa's rallied about 11%. And same thing across the board with most of these ag commodities. We're also long, official long trade on wheat. Divergent low, nice rally. And again, nothing explosive at this point in time, but just steady, consistent gains over the last few weeks. last couple months, about a 13% rally off that divergent low in wheat. Sugar's another one that's been pointed out. We had a trade, hit the first target, clipped our stop, but I've kept on it and kept focusing that it was still an objective long entry, or if you gave it a little more room on the stops, broke out above that beautiful falling wedge pattern, and from that breakout point, it's rallied so far. Had a nice day today, up another 3.5% or so. It's rallied about 25%, again from the breakout point, not from the low. And you can see here it just recently took out, it's had this area of consolidation over the last few weeks, and boom, an impulsive breakout today. So this should open the door to the next leg up, at least to that next target there, 40.47, and then this was from the old last swing trade, which is still also a longer term swing target on sugar, SGG. And I've mentioned too, Kane is another option in addition. It's just a different ETN, different company, and same kind of setup. And this one actually, I pointed out an inverse head and shoulders bottoming pattern back a while ago with the left shoulder right here. This is your head. This is your right shoulder. There's your neckline. Beautiful pattern. There's your breakout. It's been trading sideways since. Measured target would take us somewhere up, somewhere up here. You take the widest point of the pattern from the neckline down to the head, add that to where it breaks out, and that gives you a measured target. So that one's still looking good at this point in time. You've got soybeans continuing to move up. They broke out below this bullish falling wedge pattern right here. That was your breakout, and it's been stair-stepping higher since. Actually, stair-stepping higher since this divergent low, but this was a little wedge pattern here. And it has this uptrend line that I pointed out recently that offers objective long entries on pullbacks, or you could even use that to set a stop below if you're long and just ride the trend. At the very least, at this point in time, I think we're probably still headed up to test this long-term downtrend line on SOYB. Again, this soybeans ETF. And ultimately, if we break out, that would be an early indication that we may have started a new uptrend, that there's the bear market, the downtrend in soybeans and a lot of these commodities may be over. And same thing in coffee. This one's an official trade. Again, official, unofficial, I've been pointing out the ones I like. It's more of a matter of trying to manage all these positions, as official trades. Breakout here. We already hit our first target in coffee. It's above that. The second target's here, and a potential third target, which I'll most likely extend on this one as long as the charts are constructive. So those are some of the things that I'm looking at now. Stock market, I think we have a setup coming for the downside. Nice swing short. Some of you might have already started scaling into position. Some of you might be long and thinking that the Fed's going to keep pumping this thing, and that's fine. You might want to just consider the levels that I've highlighted in this video and recently as levels to maybe manage long positions. What I can tell you over the years, nobody's right all the time. You might think it's going to go up if you've been long, and and for whatever reason, and you're convinced we're going to go up a lot higher. Remember, there's something called confirmation bias and recency bias, which means recency bias is, well, the trend is strong and it's bullish and they're buying every dip, so you tend to think that's going to continue forever, and it doesn't. And confirmation bias is, taking in information that affirms or reaffirms your view on where the market's going or what's going to happen, and then dismissing everything else. And at this point in time, again, whatever case I made to short back here, objective short entries that bounces back into key resistance levels and Fibonacci retracements along the way, because I still view this as a bear market rally. Whatever objective levels I pointed out then, this is even a much better short setup, the best short setup that I've seen since the low back in March. Those others were rallies into resistance or key moving averages. This time we have some really strong divergences, overbought conditions, and continued deterioration in the macro fundamentals. So all we need to do now is mix in a little bit of a nice little sell signal, something definitive. And again, looking at these levels, it's not much. I think about just a few percentage points. It's going to take us below that level on QQQ I showed you earlier, maybe 2 3%. It should also take us below that 318.30 level on SPY. And again, it's about these FAANG stocks. This is all about, this is the entire market right here. No, they don't make up the entire market, but their weighting, their importance, they are the top holdings just across almost nearly all mutual funds out there, indexed and non-indexed, passively and actively managed funds, and just the market leaders. These are the trillion-dollar clubs: Apple, Microsoft, Amazon, and Alphabet. They're all in the that elite trillion-dollar market cap club. Apple already clearly broke down, hit that 354.50 target, so it's on a sell signal right now. And this is why I talk about that much more often than not always, but more often than not, if a stock has a clearly bearish technical posture heading into earnings, that will determine the direction that the stock goes, the next major trend from there. So will the technicals be trumped? And Apple does this. It's possible, but that's not where my money is. Microsoft, they already reported and been moving lower since. It's not melting down because there's 80% of the FAANGs, the 4 other FAANG stocks out there, are still holding the market and holding Microsoft up. Remember, this market in this day and age, it's not yesteryear's market. This isn't 1980 and 1990 or not even 2000 or 2010. The markets now are so heavily indexed, with the majority of money being into those passively managed funds like the S&P 500 index funds and ETFs like QQQ, that it's inflows and outflows that are going to determine where these guys go. They tend to move in pretty close synchronicity. So if and when these guys break, Amazon and Alphabet and Facebook and Apple, of course, that's when we get our next correction. Whether that comes at the end of this week or next week or 6 months from now, we'll let the charts be our guide. There's certainly the possibility to have another thrust up. You can see, for example, just Facebook, one of many. These charts are dynamic. They're fluid. These levels will change. If one bullish development if the PPO can remain above this zero line, the line I just drew here, and push back up, maybe we're talking about divergence 3 months or 3 weeks from now. If these divergences extend, this is a trend indicator. Bullish when the lines are above the zero lines, and bearish when they cross down below. So you can see here's a period where that signal line, the white line, was below, captured most of that downtrend. Here's a period where we were below and it was a downtrend. Every other point here, it's been the zero line was above, and Facebook was in an uptrend on all those other periods. So there are things that I will point out that could certainly keep this rally going. And again, we'll know Friday. Let's not talk much more about it. You see the levels to watch. This one's a big one to me, about 220, 280 or so. That's that previous high right there. We had several reactions there. A little whipsaw down through there and got right back above it, but I still think it's an important level that will, if taken out, would open the door to more selling. And of course, if Facebook can hold above it, then as long as it does, that keeps the trend intact. Another one I highlighted recently was natural gas. That was a buy signal on a break of this downtrend line. Rallied up, hit my 1836 target. Remember, I had to change that. The level was exactly the same. It coincided with all these reactions here, but we rolled to the September contract from the August contract. So on this charting platform, I've got to go to the next chart. They stop feeding the charts once they roll to the next continuous contract. That's this little infinity sign here you see. That's the continuous contract. Now, where does it go? I need to add one level for you, and I'll do this right now as a video because we have a few reactions. As I often say, the charts are dynamic, so is my analysis. So now I'm putting a line here at about 1870, and that's what's checked the last few rallies here. And so I think that would pop above there would open the door to my next target here at 1964. We could also add, maybe it might be a bit early, but I'm going to put it here anyways, potential uptrend line forming there as well. So if you are long natural gas and you're wondering where to place a stop, you could have a relatively tight stop above there or under these reaction lows there. No more than this. This was a pretty big level back here, about 117.45. But if that happens, you're going to go back to break even or a slight loss because that's where the breakout was. So this is a level I'm watching now. take us up there. If 1964 goes, or 1964, then we're looking at maybe that 211-ish target. And let me just wrap up here with crude. I've already done extensive videos on the metals today, so I'm not going to get into those. Crude's kind of been grinding around. This is, this is a 1-month chart. Here you can see some trend lines. I'll just say this: crude has been holding up, and a lot like the market. If we go back here a couple months, it's been trading sideways and will almost certainly follow the stock market. So if the stock market can break out of this multi-month trading range and head up, that's probably where crude goes based on economic growth expectations. And if it goes to the downside, which is, I think, based on the charts, the most likely scenario, it's going to go down. And I can say this: it'll probably, if the stock market were to drop, say 10% or more, you're probably going to get 20% or more downside on crude, because it tends to trade, follow the trend, but move more so in percentage terms. So a little more bang for your buck if you're looking for a short side play. All right, we're going to wrap it up here and get this out to you. I'm going to still keep things light over the next couple days, but if I see anything significant or any potential trading ops, I'll get those out to you. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.